Welcome back to Alpha Recap. Markets closed today with a pretty clear beat and miss pattern, and we've got a lot to unpack.
Absolutely. As always, if you have questions, you can reach us at stockalpha.ai. Ask us anything, and we'll try to answer.
So, quick roadmap. We'll hit the winners and losers, pull out the biggest moves, explain why policy and the energy transition kept showing up, and leave you with clear takeaways.
Perfect. And we'll keep this conversational. No dense jargon. Right. And the other thing is, we'll flag what to watch next.
Markets closed with materials, utilities, and pockets of retail leading the session. Meanwhile, crypto and parts of big tech felt the pressure.
Yeah, that tracks. The day had a real structural feel. Capital flowing into real assets and industrials, and rotating away from some speculative corners.
So, what really stands out here is that the energy transition and policy calendars were basically the drumbeat of the day.
I mean, when you step back and look at this, it's almost a chain reaction. Miners get news, then processing and manufacturing names move, then utilities and grid plays follow.
Exactly. Let's start with the outperformers. Materials were up on big CapEx plans, big drills, magnet plants, recycling plays.
USA, rare earth and others pushed multi-hundred million to about $1.2 billion plans. Those are the kinds of capital commitments that change investor conversations.
Utilities also had a clear day. DTE announced a 6 gigawatt-hour battery deal with LG. That's a significant storage contract.
And reports of an about $3.2 billion high-voltage DC transmission build helped too. That kind of infrastructure news gives earnings visibility over multiple years.
Retail surprised a little bit. Amazon started selling AI shopping technology to other retailers. Macy's had store revamps, and some legacy names posted encouraging updates.
Amazon playing vendor to other retailers. The student becomes the teacher, right?
Honestly, I was a bit surprised by this one. It shifts the narrative from pure platform dominance to productized services that other retailers can buy.
Short reaction. Wow, that's a lot. Not great for crypto. Big infrastructure moves.
Okay, on to the underperformers. Crypto slipped back. Bitcoin fell under $66,000, and Ethereum lost momentum amid regulatory and security concerns.
That sector had a rough stretch. Analysts pointed to ATM oversight, and some reported security incidents as fresh headwinds.
Data suggests venture capital deal flow into crypto hit a 5-year low. That's a structural liquidity point, not just a one-day blip.
Technology had selective pressure too. Big headline moves, like a large equity raise from a major cap tech company, tightened the multiples on big cap tech.
Right, and speaking of that, hold that thought for a second. One of the biggest headlines was Alphabet announcing about an $85 billion share raise.
That was huge. Analysts note that a raise of that size changes supply dynamics of mega-cap stocks and can create short-term pressure across passive ETFs.
Exactly. Capital recycling like that can alter index flows, and data suggests it often puts short-term downward pressure on related names.
Communications and media were mixed. Streaming and gaming headlines were offset by content costs and handset weakness for carriers.
So why did investors favor materials and utilities today? Because these sectors had binding, capital-intensive announcements that translate into multi-year revenue or margin pathways.
Right, binding offtakes, EPC contracts, and project financing. Those are signals that analysts and capital allocators look for when they want earnings durability.
Let's pause and walk through the cross-sector themes that connected today's moves.
Nice transition.
First, energy transition was a through line. Miners, processors, equipment makers, and grid operators were all linked by battery storage and critical minerals.
Second, policy and regulation were day-to-day volatility engines. We saw that in crypto oversight, hemp and cannabis legal timelines, and EU and UK tech rules.
Third, AI stayed relevant but split the field. Companies showing clear monetization paths were favored, while speculative AI plays got rotated away from.
Fourth, geopolitics mattered. Gulf strikes and reported US military responses lifted oil and raised defense risk premium.
And fifth, capital recycling was noticeable. Besides the big share raise, there was a large industrial sale of about $1.8 billion that shaped flows.
Okay, now the most significant moves. We'll go one by one and explain why each mattered.
First, the about $85 billion share raise we just mentioned. What happened and why it mattered. Supply dynamics and passive flow distortions.
Analysts note that large issuance can temporarily depress multiples across megacaps, especially for funds that track market capitalization.
Second, crypto's slump. Bitcoin under $66,000, plus regulatory tightening and security concerns. Data suggests this reduced risk appetite for speculative names.
And venture activity down to a 5-year low means private liquidity was drying up. That tends to amplify weakness in public crypto-adjacent names.
Third, the utilities and storage headlines. DTE's 6 gigawatt-hour battery deal with LG and reported HVDC transmission projects were the anchors here.
Those contracts translate to long-dated revenue for equipment makers and developers, supporting a shift to integrated grid solutions rather than standalone renewables.
Fourth, materials. Big capex for magnets, rare earths, and recycling. One project cited about a $1.2 billion plant and major drill campaigns.
Markets were repricing companies that can scale processing capacity. Policymakers stepping in with cleanup and procurement preferences increased the strategic value of domestic projects.
Fifth, energy and geopolitics. Overnight Gulf strikes and reported military activity pushed oil higher, which lifted traditional energy and defense-linked industrial names.
But it's worth noting that many renewables still kept positive technical momentum. Storage and module improvements are still getting attention despite hydrocarbons rallying.
Sixth, consumer pivoting to AI and experiential retail. Amazon selling AI tools to other retailers and Macy's upgrades showed that retailers with digital and in-store execution were rewarded.
That suggests AI is being judged on revenue linkage and productivity benefits, rather than press release momentum alone.
Seventh, healthcare. A significant private round, about $435 million, and encouraging in vivo CAR-T data pushed certain biotech and medtech names higher.
But policy and safety headlines kept the overall tone balanced. So it was selective strength, not a broad breakout.
All right, actionable insights. Informational only, no personalized advice. First, watch regulatory calendars and court dockets. Legal milestones often triggered outsized moves.
Second, track real project milestones for energy transition names. Announcements matter, but binding offtakes and permitting convert announcements into durable cash flows.
Third, differentiate AI winners from hopefuls. Metrics that matter are revenue contracts, adoption rates, and recurring monetization, not just claims of AI capabilities.
Fourth, be cautious on liquidity-sensitive and regulation-exposed names. Crypto and certain fintechs were showing early signs of funding stress.
Fifth, monitor geopolitics for commodity and defense exposure. Short-term oil moves and defense budgets create spillover across materials and industrials.
And sixth, follow capital markets logistics. Large share issuances and big asset sales can change float and index flows in the near term.
Now, some risks to watch for tomorrow. Hemp and cannabis federal policy, more crypto regulatory activity, offshore wind and hydrogen permitting challenges, and tech regulatory rulings.
For context, Congress blocked some amendments that would have preserved high THC hemp pathways, which increases regulatory risk ahead of a scheduled federal action in November.
Keep an eye on any filings related to the big share raise we talked about. Follow-through selling or buying data can reshape short-term flows.
And watch oil moves tied to Middle East developments. Those can swing cyclicals and defense names quickly.
Quick primer. When we say binding offtake, we mean a contractual purchase agreement that commits buyers for a project, which helps projects get financing. That's a huge practical difference compared with a press release saying, "We plan to build."
Good point. Likewise, when we say policy-driven, we mean regulatory deadlines, court rulings, or legislative votes that actually change legal status, not just commentary.
Let's do 3 quick, sharp takeaways before we close.
Go for it.
1. The market was bifurcated. Durable, capital-intensive, secular stories led, while regulation-sensitive narratives lagged.
2. Policy and capital markets mechanics moved prices today. Large equity issuance and regulatory calendars mattered as much as earnings.
3. Energy transition momentum continued to draw capital, but geopolitics and policy friction will keep volatility elevated.
Short reactions make sense overall. Lots to watch.
Before we sign off, 2 quick reminders. 1, this analysis was for informational purposes only. We did not offer investment advice or specific buy or sell recommendations.
And 2, if you want follow-up, head to stockalpha.ai, where you can ask us questions directly and we'll answer live.
Final sign-off. Markets closed with clear winners in materials, utilities, and select retail, while crypto and parts of tech felt regulatory and liquidity headwinds.
If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
Thanks for listening to Alpha Recap. We'll be back after the next session to break down what moved the tape.